The moving average is one of the most popular indicators used by technicians. We have three different types of moving average: the simple moving average, the weighted moving average, and the exponential moving average. The simple moving average is just the average of all the prices selected. For example, let's say that we want to calculate the last 5 closing prices for euro-dollar. The first candle closes at 1.15, the second closes at 1.17, the third at 1.1550, the fourth at 1.16, and the fifth at 1.1650. So we need to do 1.15 plus 1.17 plus 1.1550 plus 1.16 plus 1.1650, and everything must be divided by 5, and we have 1.16. The general formula is a summation with k that goes from 1 to n of pk and everything divided by n, where n is the number of candles that we decide to analyze. So what if we want to analyze last 5 candles? This simply means that n is equal to 5 and you need to add all the prices starting from the first one, where k is equal to 1, till k equal to 5, that is last candle's price. Once you add all the prices, you divide by 5 because n is equal to 5. Don't worry, this doesn't mean that you have to get a degree in mathematics to use the moving average. I have introduced the formula just to let you understand better what I'm going to explain later on. Anyway, why do we call this indicator moving average and not just average? This is because every time that a new candle is formed, this replaces the oldest candle that was included in the calculation of the average. So let's take back the previous example. These 5 prices refer to the closing prices of the last 5 candles. When a new candle is formed on the market, the moving average will automatically replace the oldest price with the new one. So the moving average will not include 1.15 anymore in this calculation, but we will have the new price. So let's say that the new price is 1.18. The new moving average level then will be 1.17 plus 1.1550 plus 1.16 plus 1.1650 plus 1.18. And everything is divided by 5 and we get 1.1660. So the moving average is moving up after the formation of the last candle. That's the reason of the name moving average and not just average. For the simple moving average, every price contributes in the same way. So each price contributes 1/5 of the total moving average that we have calculated. This means that if we choose a small number of candles to calculate the simple moving average, the indicator will be very sensitive to every recent price action. This is good from one side because you can have a better understanding of recent price movements, but from another side it is very easy to get caught in anomalous price movements that will give you false signals. To try to avoid false signals, you can try with a longer term simple moving average that has a smoothing effect, but it will be less responsive to recent prices. So you need to try to balance the advantages and disadvantages of having a short-term and long-term moving average. If you want to choose a long-term moving average, but you are afraid that you are not giving much importance to recent candles, you can have a look at the weighted moving average. This kind of moving average assigns different weights to each price, and the most recent prices are weighted more heavily than older prices. You can also choose how to weight the data, but I'm not going into it, otherwise this will become a course about technical indicators. Last type of moving average is the exponential moving average. That can be considered a special type of weighted moving average. The exponential moving average assigns progressively smaller weights to each of the past prices. Each weight is exponentially smaller than the previous weight. That's the reason of the name exponential moving average, and this is probably the most used one by forex traders. Before having a look at how to use the moving average with the candlesticks, we need to answer to 3 questions. What type of moving average are we going to use? How many candles do we include in the calculation? How to use the moving average? The type of moving average that you are going to use is a very personal choice. For this course, I will say that the moving average that makes more sense is the simple moving average. This is simply because candlestick patterns already focus on last candle formations on the market, so there's no need to use an indicator that puts more emphasis on recent price actions. Anyway, I strongly recommend to try all the different types of moving average, so you will know better which one suits your trading strategy and which one helps you more to understand the market. I use the simple moving average when I analyze my long-term investments on a monthly chart, and I use the simple and the exponential moving average when I study other time frames. The number of candles is another personal choice. I would recommend not to go under 5 candles and not to go over 200 candles. I personally like a period of 24 candles. Why 24? I consider 24 a magic number in forex trading. It fits almost all the time frames. If you use a 15-minute time frame, 24 candlesticks will give you information about last 6 hours. If you use the hourly chart, you monitor what happened during the last 24 hours. If you use a 4-hour chart, you have 96 hours, that is exactly 4 days. So I love the number 24 in forex trading because it seems to fit perfectly every time frame. If I also want to have a long-term moving average, I choose 120 as a period. Now let's face the most important question: how to use the moving average. There are hundreds of techniques that involve the moving average. If you search for them on Google, you will find a lot of them, but I can't guarantee that they will be effective. I will show you here the most important techniques to try to use this indicator together with the candlestick patterns to understand better the market. First one is comparing the price with the moving average. This is very simple. If the price is over the moving average, we can assert that the market is in an uptrend. If the price is below the moving average, we will say that the market is in a downtrend. This is obviously very general because it doesn't include 2 necessary factors like the time frame and the period of the moving average. It wouldn't make any sense to say that the market is in an uptrend if we are studying the moving average on a 5-minute chart with a period of 5 candles. If you want to use this technique, my suggestion is to use a time frame of 1 hour or higher and a period of 24 candles or higher. The second strategy is using the moving average as support and resistance levels. Well, this doesn't need further explanation. I think it's quite self-explanatory. Last trading strategy I want to show you is called the crossover, and it needs 2 moving averages. One will be a short period moving average and the other will be a long period one. When the short-term moving average crosses above the long-term moving average, we have a bullish signal. When the short-term moving average crosses below the long-term moving average, we have a bearish signal. Why does this make sense? Because we have said that a moving average that includes a smaller number of candles is more sensitive to recent price action. So when the short-term moving average crosses the long-term moving average, it is showing that recently the price is deviating from long-term action. So it can initiate a new trend or simply a retracement from the main trend. Okay, I stop here to be boring with the theoretical explanations, and I'm going to show you how to combine moving average and candlestick patterns to have a better view of the market.